Okay, so I've pulled up the I pulled up the post here so I could read it again. But you spoke about using the best legal structure for your business. You don't know where to start when deciding whether sole trader, trust or company is best, and the right structure usually involves balancing asset protection, tax, and simplicity, and the long-term goals of your business. You need to be considered, all of those kind of things. So, I guess what I would imagine, and I'll maybe start, but you got the competing interests of the tax implications of running the business, and what are you doing with the profits and all those kind of things that you're making along the way, with balancing the actual asset protection, whether it's in the estate or the asset itself. Now, is that along the right thinking there?
Yeah, absolutely. And there's actually, I've sort of written them down. There's about 10 or so factors that should usually be weighed up when reaching the right structure. And unfortunately, it's usually a compromise between which of those factors need greater weight for your particular objective. So, for instance, you've already mentioned the tax, and tax means income tax all the way through. So, for instance, we've got different tax rates when it comes with a company versus trading through a trust, where trusts are flow through vehicles for tax purposes and taxed at the hands of the ultimate recipient of the income as it flows through the trust. Whereas we know that companies are taxed at a fixed rate, and then we've got the franking credits on any dividends that come through. And, does that kind of structure can open up a whole can of worms in terms of, do you want to retain profits? Because you can easily retain profits, pay the tax in a company, and, they're there for next time, future investment. But, if you go with a discretionary trust, the profits have to flow through. They can't be retained. And if you want to contribute them back in, then we've got issues around Division 7A tax compliance, loans, that kind of thing. But that's only one component of the tax. What's the growth of the business and the trajectory? We've then got capital gains tax. So, for instance, assets in a company aren't eligible for our 50% capital gains tax discount. I think for the purposes of today's discussion, we should talk about the law at today's date, shouldn't we, rather than
I guess.
what's potentially on the cards and things like that?
I guess it's sounding like there's a conversation that's between, I guess, the accountants and yourself generally. Would that be right?
Yeah, look, I think you're right. It's definitely, I suggest when choosing the right trading structure or business investment structure, it's a good idea to collaborate, to get your accountants in the room, get your coaches in the room, these objectives, and then which are more or less important.
Okay, there's no one size fits all. You're seeing people, sole traders, partnerships, companies, the whole range.
Look, I definitely think when you're choosing your strategy, you should work through all the relevant factors, but there are very common trends. So it's almost a one size fits all, but a lot of people at different sizes do go with the same common structure. So, for instance, if you've got a reasonably small business, it's a side gig, side hustle, or that kind of thing, you might be fine having it as a sole trader, provided you're not worried about the asset protection risk. So it's not something that you could be exposing your personal wealth to from these business activities. And you don't really see any opportunities to stream income out amongst other family members to optimise tax rates, then maybe a sole trader is okay. Just keep it simple, stupid. Let's not overcomplicate things. Because one of the key factors with your trading structure is, I think of, how simple do you want to keep this, and also the administration costs. So the wealth, we've got to look at the funds and the income flowing through these structures for them to justify the investment in them.
Yep.
That said, a lot of times maybe you just upgrade to a discretionary trust to trade from if you're not looking to bring in investors in the future. We don't have a lot of we don't have employees, and you're not really playing in that big corporate space. Perhaps
is it easy enough to, like, for someone that's already set up and running? So on the back of a few of the videos I've put on LinkedIn, I've had a few people kind of reach out to me in some conversations. Some people are kind of 12 months, 18 months into already doing something. They're actually making some money now. Is it too late to change? How difficult is it to change from one to another?
It really depends on the tax and stamp duty consequences. So the sort of straight answer is it's not hard to change. Do you want to pay tax? And I know, so in Queensland, we still have business duty, so stamp duty on business assets. I know that, a lot of the southern states don't have that anymore.
Yep.
So it kind of comes down to the value of the business. And often if it's a startup, the value is really tied to an individual's personal exertion. Then you can argue, I mean, you're the financial guy, but, you can argue that at that point there may not be a huge amount of goodwill value beyond, if you took the key person out of the business. And
what's actually left if they've gone,
Exactly. So you can usually get like a reasonable value, which means at that point you don't really have a capital gain, and in that case you just move into the right structure. If we are looking at an established business where there is value, then you can look at there's small business concessions, there's the small business rollovers, and then we've also got capital gains tax rollovers as well. So there's usually kind of 3 tools we can look at to manage the tax consequences.